here with James Rainwater as a CPA. He actually, I've been working with him for about a year now or so, maybe a little bit less, and learned some great stuff. Has a great service. And, I always am telling chiropractors and business owners like some of the things they need to do tax wise and maybe some suggestions. But it's one thing coming from me, but an even better thing coming from the actual accountant. So, James, tell us a little bit about accounting and how you came to be in your firm and what you guys do.
Sure. Yeah. Thanks for having me.
Yeah, man.
I appreciate it. So there's kind of three main pieces, like a small business owner or a doctor's practice is looking for in accounting. One is just the accounting itself, the bookkeeping or the accounting, making sure the records are good and accurate. The second is maybe some financial advice, like maybe an outsourced CFO would do, where it help guide you with the business, make good financial decisions, that kind of stuff. And the third is tax planning, tax compliance, tax planning strategy, that kind of stuff. And that's what we do. That's what our firm does. We've been around for about 12 years. I've been in the industry for 30 years or so. And just really, noticed that business owners are lacking that proactive kind of planning and strategy advice that is really, really necessary. So we just double down on that, and that's what we do, and we enjoy it an awful lot because we get to help a lot of people.
Yeah, and you guys are pretty good at it too. So,
Thank
what
you.
is the role of accountant? Because I think a lot of times we think it's our accountant's job to do this and our accountant's job to do this, and there's quite the difference between planning for tax, which I think a lot of accountants don't actually do, from my experience, and what an accountant is. But at your firm, we're doing the planning and the accounting. So, what is an accountant's role, and what is not their role?
Yeah, it's a good question. Most accounting firms just don't have a good model for being proactive. It's a very reactive model where, after
Mm,
the fact, they're coding transactions, or after the fact, they're preparing the tax returns. And we wanted to figure out a way to really be proactive and figure that out for clients so that you're ahead of the game. You're not figuring out in January what the tax bill is going to be. You want to
right.
know that throughout the year, like your other expenses, so you can plan for it and budget for it. The problem is a lot of business owners think that that's what the accountant is doing at all the firms, and that's where they get frustrated. That it's kind of piecemeal. There's not a lot of advice, and some firms do it and do it well, but I'd say the industry is really lagging there and hasn't caught up to what the clients really want and need.
Sure. I think the public has a perception of your accountant supposed to be watching your money and looking over everything and then telling you to do this and telling you to do that. And that's not really the case unless they are proactive like you and are planning for stuff. They're kind of just, like you say, in some of your videos, that they're just kind of putting the numbers in the boxes and
Yeah.
doing their job. And that doesn't mean they're not doing their job. It just means they don't have that extra planning, proactive piece.
Yeah.
And so I think a lot of people think it's like, oh, it's my accountant's job to do this and do this and do this. Well, if they're not really they're more like the reactive type accountant, like you described. That's really kind of their model and how things go, and that's pretty typical. So I think tax planning is something that every business owner and chiropractor and each one of my clients needs to be doing actively. And if you don't have an accountant that's planning for that stuff, especially if you're growing, if you come on with a coach like me and we take your income up double or something like that, we really got to be planning for that. Otherwise, you may get caught with your pants down at
Yeah.
the end of the year.
We see that a lot where, a lot of our clients are in growth mode. Almost all your clients are in growth mode. And for some reason, because they're not like recalculating that tax liability, they're still expecting their tax to be the same as it was last year or similar to last year. And
Right.
you put that model together and its taxes are double because the income is double, or more because you're going up, scaling up in tax brackets. So that can definitely be a surprise if you're not on top of it.
Right, right. So getting into some specific strategies and roles without giving direct advice, you're going to need your own attorney and own accountant for that. But just general of what these definitions are and kind of how they work with the IRS and taxes. The first one we have is the Augusta Rule. I've been doing that for a few years now. And these are these tax strategies, I believe, as they're coined and called, they're actual legitimate things. They have to be kept up with properly and proper documentation, but it's not like sometimes clients will ask a loophole or like almost like it's like a gray area type thing. And that's not really how it is. These are legit tax code and law things that you can actually do that are legal and perfectly doable, but has to be done correct. So the first one, the Augusta Rule. What is the Augusta Rule, and kind of just a brief overview of how that works?
Yeah, the Augusta Rule is a name that's been applied because of the Masters tournament, where they figured out homeowners on the Augusta golf course figured out during the Masters tournament that there's a piece of the tax code that says, and like you said, this isn't like some odd loophole or wacky thing. Like it's
Right.
literally written in the tax code that if you rent your home 14 days or less per year, you don't have to pay taxes on that income. So they, lots of smart, wealthy people living on Augusta figured out they could rent their house during the tournament as long as it's 14 days or less. It can be, $100,000 a day they're renting their house for, and they don't have to pay taxes on that money at all. It's simple. It's in the tax code. It's been through tax court. It's passed. It's survived. The way we use it with a lot of our clients is you obviously can't rent your house to yourself.
Right.
But if you have, a business that's separate, you have an S Corp or a C Corp that's separate from yourself. That's what a corporation is. And again, we're not giving legal advice,
Right.
but you can rent your house to your business for 14 days or less per year and not have to pay taxes on that income. Yet it's a deduction in the business. So it's kind of a free money strategy where it doesn't really cost you anything to do the strategy. Yet it reduces your taxes pretty significantly.
Yeah, it's a quite an incredible thing, but it has to be. We won't get into what you need to do and how you need to document and stuff like that. That's for your own accountant and attorney. But there has to be documentation done and things like that to keep it to the proper standard. But it's a great thing to do. And that kind of brings me into, sometimes people confuse that with a home office reimbursement. So what's the difference there, and what's the home office reimbursement, and how does that one work?
Yeah, that's a good point. And even a lot of CPAs kind of mess that up or confuse the two, where, with the Augusta, you're renting your house to the business for an event. Maybe it's a board meeting or, a pool party for your team, crab feast, something like that. So it's like a special event. It's not the office. And specifically, it needs to not be the office. But for the home office reimbursement, pretty much, especially since, the past few years, pretty much everybody has a home office now. It has to be a dedicated space. And then you can take a percentage of the costs of your home, like mortgage interest, insurance, real estate taxes, security fees. There's a lot of things that can be taken and deducted for the, having your office in the home and using that space. So it's interesting because we've seen some CPAs will say, oh, no, that's too aggressive. That's old. You can definitely take a home office now, especially now that everybody has a home office. You see a lot of people forget a lot of expenses, like home internet. You can take 100% of your cell phone. You can take 100% of. So just missing a lot of pieces like that.
Yeah, and all those little things, they add up over time, right? It's like your cell phone may not be that much, but we add it up over the year, and we add up these percentages over the year, and it can be a big chunk of our taxes. And so basically, what you're saying is with the home reimbursement, or excuse me, the home office reimbursement, is that like your office is a percentage of your house, and then so that percentage, you can take that percentage as part of the other bills because it takes up a percentage of those bills.
Exactly. Yeah. And sometimes the office is just kind of small and in the smallest bedroom in the house. But we've got other clients that use their entire basement as the home office, and that can be half or a third of the total cost of the house.
Right. There's a lot of factors that go into that, and it's going to be situationally based. There could be a bathroom in there. You could be storing some records at your house if you're a provider, or you could have some kind of storage at your house. I have one part of my garage that had all the business decor and saved things and paperwork and stuff like that. So it's different situationally, but you have to get that proper. It has to be done and calculated correctly. We don't just pull that number out of the air, you know. And
Exactly.
I've worked with an accountant before, and they just pulled the number out of the air, and it was like, oh, where'd that come from? It's a nice number, I like it, but where'd that number come from? It was a little bit aggressive, you know. So it has to be done correctly and legitimately. So another thing, especially right now, and you know, being at the end of the year, a lot of people will use the strategy of buying a vehicle, and more specifically, the heavyweight vehicle. So how does that one work a little bit, and the kind of maybe do's and don'ts, and what to do with that? And I know there's been some changes with depreciation, I think, in the percentage that you can take in the first year recently. Like maybe it used to be 100 and now it's going to 80 and then kind of going down. So what's kind of the story with that as well?
Yeah, so a lot of people have heard about the 6,000 pound requirement. You know, if it's under 6,000 pounds, you can still buy the vehicle and depreciate it. You're just going to have to take those costs over 5 years, spread over
Right.
5 years. If you buy a vehicle that's over 6,000 pounds, which is most your heavier SUVs or Tesla, something like that, you get the advantage of bonus depreciation. So you can accelerate that depreciation into the first year. What changed in 2023 is where it used to be 100% bonus depreciation, and you can take all the costs of that vehicle. 2023, it's only 80%.
Yes.
So you can take 80% of that bonus depreciation in 2023, and then that you don't lose that other 20%, but it's going to be spread over 5 years. So you have to depreciate it.
And so, and both of those can be different strategies depending on your situation. You may not want to, in certain situations, bonus depreciate. You know, if you went out and got a new Tesla or Escalade, it's a lot of money. It may make more sense to spread it out over 5 years. I think maybe in some cases, it just kind of depends on where you're at, what you owe, what the strategy is. But that's where it comes that a good planner needs to be on your team with what you want to do, because there's pros and cons to both.
Yeah,
For sure.
like both. Yeah, and say, you know, if you're in a low tax bracket now, because maybe you're starting out and you're going to definitely be in higher brackets in the next few years, then maybe it does make more sense to spread that out and depreciate it over 5
Absolutely.
years.
So something that you talk about a lot, I see on social media and other places you've been, is the R&D. And I think, you know, not being anywhere near claiming to be an expert on it, but after knowing what I do know about it, I think there's opportunity for a lot of not just chiropractors, but physicians and other doctors um, to be taking advantage of that. So what's the government saying about R&D and that situation?
Yeah, R&D is a great benefit, super valuable tax credit. And it's an actual tax credit where it reduces the amount of tax you owe versus reducing your income to reduce your taxes.
Right.
So really valuable. It applies to businesses that develop a new product or service for their customers or clients based on a scientific approach. So it gets missed, I think, a lot in the medical community where these things are happening. A great example, we have a client recently we worked with that was developing new surgical procedures based on a new piece of equipment. So they got this new piece of equipment and they needed to design the actual procedures around a new service that they were going to offer. So to the extent that they're using a scientific process, you know, can document the time, you know, and costs related to that, then we can use that as research and development and, you know, calculate the credit based off of that.
So this is really dumbing it down and putting it simple, but you implement something new in your office, but you're kind of doing the research and figuring out how it works and the results that it's going to get.
Yeah. And you could even hire somebody as long as they're based in the United States. You can hire somebody to help with that process and design that process.
Awesome. So without giving direct advice, doctors, I know you have several clients who are physicians of all different types. What are some accounting things that you really look for to see if they're doing when you work with a client like that?
Yeah, on the R&D specifically or more in general?
Oh, no, just in accounting and tax planning in general.
Gotcha. Yeah, one big thing with doctors, physicians is just the organization to make sure we're capturing everything. And looking at the timing of payments, both of the bills and receiving. Sometimes it makes sense to look at accrual. Most people are cash basis, but maybe it makes sense to look at accrual if you've got some, payments that are coming in, like bills that need to be paid, inventory that needs to be paid, and then being stretched on insurance. The home office is one that gets missed a lot, because if you can establish, as a physician, a home administrative office, then driving back and forth to the office where you see patients is now that's a deductible expense,
Right.
whereas before it used to be a commuting expense.
Right. Basically, sorry to interrupt you there, James, but basically a lot of people think that that's all deductible, but it's not. If you're commuting from office to office, it is, but
Right.
leaving your house and going to work, everybody has to leave their house and go to work. So that's their stance on it, that mileage is not deductible. But if we've got home office and working office, that is all deductible because you're commuting between both of those. Is that correct?
That's correct. Yep.
Yeah. So that's really all the big stuff I wanted to hit. Is there anything else that maybe popped up into your mind with that little chat?
Yeah. There's going to definitely be some changes coming down the road. This has been kind of a quiet year for tax changes, other than like the change in the bonus depreciation, and we've got an election year next year. But we've got some things that are going to expire from the Tax Cut and Jobs Act, like AMT. Alternative minimum tax is going to start being a factor again, which affects a lot of doctors and physicians. So planning over the next few years, I think after the election, we're going to see a lot of tax changes, depending on how things go. So it's going to be really important to kind of stay on top of these things and watch them over the next few years to plan for them.
Yeah, absolutely. Couldn't have said it better myself. Well, my friend, thank you so much for your time. That was less than 20 minutes, but the amount of stuff that we packed into there, that was really, really good. So we appreciate you. Know you're super busy this time of year. It was super busy always, but more busy this time of year. So really appreciate your time. Thanks for answering some of those questions.
Yeah.
And we just appreciate you, man.
I appreciate the opportunity, and it's always a pleasure to chat with you.
Thanks a lot, man.